current scenario right now in the startup ecosystem as well as in the investment sector, I can only think of Darwin's theory, survival of the fittest. Now is the time when startups are finding it difficult to get the capital, and also there is a bit of conservative nature when it comes to investors as well. Uh, in your opinion, how has been the last year, and what changes, what transformations do you foresee going forward in the whole ecosystem?
I think it's a telling reminder that, eventually, so the question can be asked from many different dimensions. To put a more objective spin to it, for everything that is innovation-led, venture capital-led, technology-led, I think we almost got that reminder in memo a few times in the last 5-6 years, but the bull market somehow sustained and basically pushed that, conversation to a later date. That's the way to think about it, right? And we thought the pandemic will answer that, but the pandemic created a incredible sort of surge in capital, and you got even more of, relatively speaking, bad behavior, in the sense that while you're investing capital to build great new business models, new technologies, eventually exits as demanded of us, and an eventual end state, steady state path for all of startup India is a function of whether you know how to make money, right? I mean, you can't sell innovation alone in a relatively young market like India for innovation, right? So in a super large market where you have 200, 300, 500 billion dollar companies, to sell innovation even for $1 billion is possible, right? In a market which is resource starved, capital starved, you can't sell innovation alone. You got to sell the ability to make cash flow on top of that innovation, right? And India is that kind of a market today. So I think where people need to see that this somehow makes money, otherwise they're not buying just the innovation. And what I mean by that is, when I say who's buying that innovation, it either has to be a buyer in the M&A market, or it's got to be a buyer in the public market, right? So both those investors are saying that until I see that, I'm not going to plunk a huge amount of capital into the market. So private market, thank you, you took the risk, you built a whole bunch of innovation, but until I see that, I'm not playing. So as long as there was liquidity, you kept pushing that problem later because private markets were able to finance it.
Well,
which is the US market. Because even there, they will give you a lease of life for some time, but it's not to perpetuity that they will support that burn, even if private markets are 10 times more robust. Last year's private equity capital in the US inventory problem exists there as well. So I don't. You can run away from the idea that you have to build to sustainable sort of economics in any market. So this year is a reminder for that, and basically saying, hey, if you can't do that, then we gave you enough capital in the last 2 years. Figure out if you can manage with those 2 years of capital. Right? There's no fresh money to take the same risk all over again.
I agree. I strongly
and that is basically. That's what we're seeing in the market. And that's why people are slowing down, because they don't want to fuel something which is otherwise not stabilized from a business model. And new risk they're willing to take, but at a very, very risk-adjusted price point. So what was available at $20 million last year will be available at $10, $13 million this year. What's available at 40, 50 will be available at 25, 30. So because it's risk-adjusted for how long it will take to get the next round, how you have to temper growth. You can't buy growth in that sense with hard cash. You got to buy it organically with product market fit. So everything then changes your IRR expectations or your speed of that return expectation, and that adjusts itself in the price. So basically, internal cap tables have to be very strong to support continuing burn in the companies, or your internal balance sheets have to If one of those exists, that's why you won't see an external funding round in a market like this. I think it takes another six months to 12 months to fully correct, because there is not 1 or 5 or 10 companies like that. There are couple of hundred companies like that. If you add all the unicorns, all the unicorns, there are a couple of hundred, right? So that will have to happen at the later stage level. Early stage, we are playing for 10-year outcomes. So if we don't take the risk now, when will we take it? Right? So you are looking for great founders, great market opportunities, and we'll talk about. We wanted to talk about climate, and those are the kind of ideas where people want to take that risk today, and that's what venture risk is designed to take. What can truly be sort of shifting on the market front 8-10 years from now.
I agree. There has been a lot of, change for the better, just because market is now trying to stabilize. As you said, in next 6 or 7 months, we'll be seeing market stabilizing. Also, you talked about exits. There has been so much of up and down when we look at public market IPO filing. Uh, in fact, in the last 2 quarters, we just seen two unicorns joining the club. Instead, we saw many joining them in the last year. Now,
Yeah.
there are a couple of factors that's impacting the capital flow towards the early stage. As you said, you are investing for the large term goal, let's say 10 years, or let's say 5 to 6 years goals. Now is the time to take the risk. Instead of taking it at the growth stage level. In your opinion, what are more factors that's impacting this capital flow? Because you at Blume Ventures typically invest at pre-seed, or let's say pre-series A levels. How are you seeing this proposition going forward, when investors are more keen to invest at early stage rather than later stage? There is more rigor. I agree. Investors are more critical in terms of how they are infusing the capital and where they are. But what are the couple of other factors?
No, so if you think it's around how you portfolio construct for risk, right? So suppose you are a relatively later stage investor and you take 20 investment bets, right? And you divide up primary bucket, half of your capital available into those 20, and then you invest your follow-on reserves when those 20 break out. Okay, but typically your average check size might have been $15-20 million, let's say. So that investor will now take a little bit more comfort in mitigating that risk by playing 30 investments, let's say. So they might do 15, which is one step earlier, because they have reserves to go deeper if they want to. But if they make a mistake with the larger play, they can't recover from that. So, but even if one of these two work out, they can recompensate for the risk that they took, right? So that is at just Series B to Series A. If somebody comes a little earlier. If you come from A to seed, an A bet is like $5 million. A seed bet is like $1.5 million. You can make 3 to 4 investments with the same capital. So it's about, please understand that our business is organized into 3-year primary cycles. Everything has to be risk adjusted in those 3 years from a primary bet. Follow-ons can go up until the 5th or 6th year. I have to diversify risk in the right season, and I have to concentrate risk in the right company. Right?
I loved it.
And that's exactly what's happening. So basically, if you see, a larger fund like a Tiger, Sequoia, Axel, Nexus, all of them doing a little earlier stage, they essentially it's expressing underconfidence in either valuations or in the possibility that the later stage bet can become $1 billion company versus the possibility that this early stage opportunity can become $1 billion company. And you can still make 2 bets out of 3 wrong and still over-index on the early stage risk today, right? Also because you have no idea how capital markets are going to play out for the next 2-3 years. And a lot of this momentum and growth is driven by what additional capital can come, which is totally slowed down. So suppose you're a Series B investor, can you predictably say when your Series C guy will show up? No, you can't.
No idea.
Right? Unless the business is already trending towards profitability, right? Which is very few companies of that nature you'll find. So people are being picky, but they will pick well in this market. They will be spoiled for choice. Each investor is different. So please don't categorize them as B, C, India, US. Everybody has a different lens.
That's right.
You can't judge one or the other because you don't know their investment strategies, right? You can't tell a cross-border investor is the same as an India investor because he can access US risk. An India investor can access two types of risk in India and can manage it better because they're on the ground here. And somebody likes, more path to profitability business. Somebody likes more growth businesses. They will pick differently. So that's why there's never the desired level of certainty that an observer of the ecosystem or the press asks, right? When you ask a question, there's too many little pockets of uncertainty, too many different strategies at play, right? And that is why venture is such a tough business, right? You have no idea whether you get funded in the next round or not. There's
Yeah.
no such guarantee.
If I
For
can
every
say
round
that,
for every round that you see and report, please understand that if they've gotten one term sheet, they probably pitched 50 investors. So the other 49 thought it was a bad company or not worth investing into. So in a bull market also, 90 to 95% of investors have said no. Please understand that. Right? And so it's a very fundamental truth that people miss. Just because you saw funding news, it does not mean that there were 18 people lined up to give him money. There were only one or two max. Only one or two.
I can understand.
Okay. And so that in a bear market becomes more challenging because you have to have even more conviction for that same one or two people. See, the other 45 would have said no, even in a bull market. How are they relevant for this conversation? It's only down to those last 4-5. So essentially, what we're seeing is far more conviction-led investing, far more value-driven investing at this juncture. People are sitting on cash, and they will continue to look for those opportunities for the next 12 to 18 months, is my take.
I agree. Thank you for this clarification and so much of information as well. If I can say, in the last 6 months, this was like a time of reaffirmation where founders need to focus on correcting their unit economics, path to profitability instead of running after the valuation game. They need to look for revenue generation or let's say value creation, not just the numbers and brand name. You recently at Blume Ventures launched your India dedicated fund. What are your plans with this fund specifically? And what are the sectors you are aiming for? And what could be the ticket size you are like on an average looking at?
So we've been super consistent in the risk we want to take, right? In 12 years, we've not changed our entry point beyond seed or pre-seed A, right? So that's what we do. I just released my blog on the website literally an hour ago. So it actually talks to everything that you just asked in the last question. It talks to why we love the space, why we have conviction, why we'll continue to do that. That said, that market has also evolved. We used to write $250,000 checks, then we used to write $500,000 to $1 million checks, then we wrote $1 million to $2 million, and now we're writing million to still $750K to $2 million, let's say in Fund 3. We still write mostly million to two as starting. But so two things. The stronger the founder, the more expensive the proposition. Second is a lot of Blume equivalent from 2011 are born now. So they're willing to write 250 to 500,000, which I don't want to write. It's very early. So if they come and lead a $500K to $1 million round, they've already got one institutional round or semi-institutional round.
Yeah.
Which means they are likely not to take my money right away, and that would have been taken at $3, $4, $5, $6 million valuation. So I have to wait for 6 months to a year, and by the time I wait for that and they actually have some progress, if they're a good company, they'll again ask for $10, $12 million valuation. So what's happened is ticket sizes are naturally growing up. My ambition for owning more of the company has gone up. So my entry point is grown a little to $1.5, $2 million, $1 million in first-time founders, where valuations are still in the $5 to $10 million range. Second-time founders, if they've shown an successful cash exit, they're rock stars, right? So they know how to build to 50 to 100 million. So you assume, though it's a illogical assumption, you assume that they know how to build team, build product, build PMF, build GTM, and at least take a company to 50 to 100 million, if not much more.
Yeah.
They're playing and you're playing for the $1 billion outcome. So the risk adjusted, they want a much higher price, a much higher ticket size. So we've written our first term sheet where we have actually led with $4-5 million in a $10 million round to
So
such a
good.
founder.
Yeah. So
So
good to know.
that is why the big fund. The big fund is because you can play a little bit more boldly in anything which comprises of early stage risk. But historically, in a $100 million fund, if you came and said $10 million round is happening, can you play $5 million? It's a lot of risk to take up front. In a $250 million fund, you can take that $5 million risk. Not 10 times, 20 times over, but you can take it 4-5 times. That's all you'll see in one a quarter. You'll see of a great founder you want to work with of that nature. So that's kind of how I think through risk differently in Fund 4, but otherwise we're the same firm. Yeah, we're going to do what we know, what we like.
Looking forward to it.
Yeah,
If you can talk about how IVCA now looking at the whole ecosystem evolving. Uh, in this year, in April, IVCA talking while the appointment, they aimed for democratizing the capital via through funds of funds, and also tried to figure out other avenues, let's say global capital. But then there is certain focus on promoting domestic capital still.
yeah.
Uh, from a policy viewpoint, what are your points right now? What would be the focus areas going forward? Also, we are near budget. What are your expectations from the government
Yeah.
from a policy viewpoint?
So good question. So just one clarification. So IVC is a industry body for all types of investors, right? And so because we realize that all the needs are not identical, Cat 3, sectors, real estate, tech, etc., private equity, venture, and then overseas domestic. So there's many ways to cut the sort of the puzzle, right? Okay. And so we have sub councils led by the stakeholders from that particular subsector, category of funds. So there'll be a venture council, there'll be a PE council, there'll be a global investor council, there'll be a real estate council, etc. So please understand that when I speak at a general level, 10,000 feet, but each of these sub councils are actually working at 1,000 feet level as well.
Understood.
Okay.
Understood.
So it's a very broad brushstroke. There's too much going on at any point in time. Every council has 10 different issues with 4 different regulators or government bodies that they're constantly trying to address. Now, coming to the question around what expectations of the budget are, especially because, yes, you're right, the budget stuff typically tends to affect the domestic capital and domestic managers the most because it has tax issues, it has concessions on one issue or the other, it has startup fund, it has all of the domestic issues in some sense, right? And it has been consistent for a decade, so it hasn't changed, right? So we see small ease of doing business tweaks there from one regulator or the other, right? Or one government entity or the other, right? Taxation, whatever. So we'll keep pushing, right? It's an iterative process. We tried last year. We got an expert committee. They've given their submissions. We'll see how much of an impact that's going to have on Feb 1st, right? So led by Mr. Damodaran, you saw an expert committee set. They gave us all a hearing. They gave IVCA, CII, CBDT, RBI, SEBI, everybody a dialogue to just understand how the issues are perceived by one stakeholder or the other. So that happened in the last quarter. We'll know whether some of that translates to action or not, and whether the expert committee continues for another cycle, because these are not small fixes, these are not one-time fixes. We have to get the industry to a shape where it looks globally competitive, which has been our broad, if you ask me, at my role as chairperson, my crib is that we are not, domestic is not set up, domestic AIFs are not set up to be globally competitive. So you'll say, but why is that required? You're investing here. Now, who is my competition? It's global funds.
Absolutely.
Right? It's not, yeah. So capital is the most amorphous of exports and imports, right? And you're basically setting up the domestic industry for a disadvantage, if not failure. And that is a shame, because you're saying people are not easily going to walk in through the door and do FDI with local employees necessarily. It takes a long time to set up that confidence, right? However, the AIF industry has shown that there are literally hundreds, if not thousands, cumulatively, of LPs who are willing to invest in India, as long as they outsource that responsibility to a manager, a fund manager. Okay. A lot of us are based in India, some are based overseas. However, the bulk of the capital sits overseas, right? So, when they give a foreign fund versus a domestic fund, the capital should look identical. It does not today. When they give money to a public manager versus a private manager, it should look identical. It does not today, because capital gains is more. For somebody who holds a stock for 366 days, he gets a stock, not even value addition to an employment or to labor or to capital assets in this country. They get half the capital gains tax than somebody who holds it for 3,660 days.
Disparity.
Disparity of what scale? We're nation building, they're trading between two people, right? It's going from shareholder A to shareholder B. Here we are basically creating jobs, we're creating infrastructure, creating data, you're saying create world-beating companies, and you're saying no, but that's not as relevant as public companies. It's tragic, right? So then you're not allowing me to compete with public markets. And then finally, the domestic investor has worse terms than the overseas investor, partly because of this lack of parity, but also because of everything around their ability to participate in this market versus what a foreign investor has to do to participate in the market. So if you look at the investor, the companies, the managers, all of us need to get on the same level playing field as a global investor or a global company. Our companies are competing with global companies. Flipkart competes with Amazon, not with only Big Basket or Zomato, right? They compete with Amazon and they compete with Google and they compete with Meta and they compete with Uber, right? So how do you expect us to compete if you are not leveling the playing field? It's generally been our macro submission, and that's all we'll say. We'll keep saying only the same thing. I don't need any special benefits. We've given up on the idea that we'll get any special freebies. We're just trying to push on the fact that we need a level playing field.